Good morning, this is Jeff Hildebrand for TBL Traders. Today's video is going to be on futures, a general overview of futures and what they are. I'm going to speak about a few things. I'll come back to the subject as I go on. What they are, meaning I'm going to speak about futures as a contract, the right to buy or sell at a certain price. And futures are basically an underlying product plus premium. The contracts are leveraged. For futures, contracts are made up of different types of delivery, cash or physical. They're often used as a hedge against risk in the underlying, and they're often used as well as speculation, as a hedge, as I mentioned, and occasionally as arbitrage. So I'm going to speak rapidly about each one of those subjects. Okay, so quickly, the first. Futures are a contract, a right to buy and sell an underlying at a certain price. I'll give you a quick example of what that looks like with my broker or my trading platform. If I take the index ES, it's titled the E-mini S&P 500 futures contracts. You'll see, for example, this outlines the makeup of the contract. It's a future, it's cash settled, the multiplier is 50, which is the leverage. This is the exchange that it's trading on, and this is the expiration date, contract month and expiration date. Those are the principal, that's principally what makes up a future contract, and those are the different things we're going to look at right away. So let's start with the contract itself. It's an underlying plus the premium, as I said. Okay, so the underlying is the S&P 500. What's the premium? A lot of times people don't understand premium on a futures contract. I left up on the screen here, I think you can see it okay, the September and the June S&P 500 futures contract. Notice the prices against the S&P. So the nearest expiration, June, is at 1957.75. The index is at 1957. The premium is the difference between those two. If we go out to September, 49.75. So we're at what, $8 in premium if you get the future out to September. So that's why people talk about premium with futures contract. It's not just the index times the multiplier here, it's also adding the premium. That's important. Understand leverage. Let me show you something for the leverage, what that means. We've talked before about the margin requirements. Here they are on the ES. Intraday initial 2,700, maintenance 2,162.50, overnight initial 5406.25, and overnight maintenance 43.25. Let's look quickly at what the leverage would mean for me. Okay, so the leverage would look like this for my trading routine. Ignore some of these other intraday initial maintenance values. These are old numbers, but I have a look at the E-mini S&P 500. This is what I follow this is what I calculate for my leverage based on the multiplier. What this means is one contract of an S&P 500 has a tick value of 1250. Let's say it's at, what are we at now? It's at 1949.25. So I'll take 1949.25 to get an idea. 1949.25. That'll show me the nominal value. It's that 1949 times 50 gives me 97,462.50 as the nominal value. If it goes to 2,000, which seems to be the resistance, as you can see, 2,000 times 50 is 100,000. The nominal value is 100,000. My profit from today to 2,000 would be 2,537.50, or 2.5% roughly. Now, what's important to understand about that is, well, it's important to understand how leverage works, and it's important to understand it futures contracts have different multipliers. So tick values for different products will be very different. The 10-year U.S. bond is $5 per tick. The euro future is $12.50 as well. Gold is 10, etc., etc. So futures contracts are different. Be aware of how they're different. Okay, now I'm going to look at delivery. What's the difference? What's important to know about delivery? Delivery in the S&P 500 is cash. Okay, but if I look at grain futures, for example, delivery is physical delivery. Okay, with a multiplier of 5,000. What does that mean? That means I risk to get delivered 5,000 bushels or 136 metric tons of soy if I don't close out this futures contract position, if I bought it before the expiration. So be very careful about the difference between cash and physical delivery. If you're holding on to a soy contract when it expires, you might get a lot of soy. Let's also look at why people use these things. As I mentioned, they use it for speculation, hedging, arbitrage. But in the case of grain futures, gold futures, even S&P futures, people are hedging underlyings. The classic story that you read about or hear about, probably the recent futures came into being, is that farmers, or for example airlines, they need to hedge their underlying costs. So a soy farmer or enterprise that's growing soybean will be able to manage their pricing in time. They know what they're going to pay for soy futures today in September, which is very important for enterprises or large farm conglomerates. Airlines hedge and use fuel futures, oil futures as well to manage their costs in the future. So that's important to understand. Okay, hedging and arbitrage. Hedging. Well, let's talk about arbitrage first. Let me mention arbitrage, what it is. Some of you may not have heard it or understand it. Some traders are able to trade off the difference in the futures price farther out and closer in. So this difference, people are able to, even on different exchanges, they trade the very small differences in the prices over time and across exchanges. And with the underlying as well. So if the futures price by their calculation is just slightly out of whack, more expensive or less expensive than the real underlying, the SPX, they can buy blocks of what make up the SPX and sell or buy the futures. That's an arbitrage. I don't know how to. I don't know. I've never tried to do that. It's a complicated type of trade, and for institutional traders principally. It's also possible to hedge. Your margins work a little differently, but it's also possible to use, for example, the S&P 500 options and the futures, ES future, to make a type of spread trade. That's an interesting, and you can do that with a lot of the other products. Gold, for example, here you can use the GLD ETF if you want to do different types of spreads. Again, they don't correspond exactly, but you can manage the quantity and manage your delta when you buy or sell options in the GLD, for example, and buy or sell this futures contract. That's true with the ES. That's true with a lot of other things. That's about it, I think. Keep in mind also that there's futures on just about everything you can imagine, and futures can be seasonal. So that's another point I would just want to cover quickly, and then I'll stop. Futures can be seasonal. So if you're trading soy futures, just to look here at this volume, July and November are important futures contracts for soy. August, September, January, March, they're not as important, and there's a reason for this. And that's why people study, make full careers on just trading grain futures, for example. So that's about it. That's an overview, a quick overview of futures.